The global economy didn't collapse in 2008 because of a hacker, a shadow cartel, or a single criminal mastermind. It collapsed because of a system that followed the rules perfectly. That's the part most people still don't understand. Trillions of dollars vanished, millions of lives were destroyed, and yet almost no one went to prison. Not because the crime was hidden, but because, on paper, it wasn't a crime at all. This wasn't a scam in the traditional sense, it was something far more dangerous. A financial machine designed to generate profit without accountability, risk without responsibility, and complexity without transparency. And by the time the consequences arrived, it was already too late. To understand how the 2008 financial crisis really happened, you have to forget the story you've been told. Forget reckless borrowers. Forget bad luck. Forget the idea that this was an accident. What happened in 2008 was the logical endpoint of incentives that rewarded deception, punished caution, and turned trust itself into a commodity. And the most unsettling part is this: the system didn't break. It worked exactly as designed. The story begins quietly, years before the collapse, inside a market most people never think about. Mortgages. For decades, banks made money the boring way. They lent money to people who could afford to pay it back, collected interest, and kept the risk on their own balance sheets. If the borrower failed, the bank absorbed the loss. That created discipline. Lending standards mattered. Verification mattered, but that changed when mortgages stopped being loans and became products. Banks discovered they didn't need to hold mortgages anymore. They could sell them, bundle thousands of home loans together, slice them into pieces, and sell those pieces to investors around the world. This process was called securitization, and on the surface, it sounded reasonable. Spread the risk, increase liquidity, make housing more accessible. But beneath that language was a quiet shift that changed everything. Once banks could sell the loans, they no longer cared if borrowers could repay them. The risk was no longer theirs. It belonged to whoever bought the package. That single change broke the connection between responsibility and consequence. This is where the first loop opens. If banks weren't punished for bad loans, why not issue more of them? If profits increased with volume, we slowed down. Lending standards collapsed, not because of greed alone, but because the system rewarded speed over accuracy. Income verification became optional. Credit scores became flexible. Adjustable rate mortgages were sold to people who barely understood how interest worked. These loans were called subprime, but they weren't hidden. They were openly issued, openly sold, and openly repackaged. And here's the part most people miss. Subprime loans didn't stay subprime for long. Once bundled into complex financial products, they were magically transformed into something that looked safe, extremely safe. This is where rating agencies enter the story. Moody's, Standard, and Poor's, Fitch. Their job was simple: assess risk. Tell investors how dangerous these products really were. But they were paid by the very banks creating the products. A built-in conflict of interest that was not only legal, but normalized. If a bank didn't like a rating, it could shop for another one. And so, pools of risky mortgages were stamped with the highest possible rating, AAA. The same rating as government bonds. The same rating as institutions that had never failed. This wasn't a mistake. It was a business model. Complexity made scrutiny difficult. Models replaced judgment, and everyone involved could plausibly claim they were just following procedures. This is the second loop. When no one is personally accountable, everyone keeps moving forward. As these mortgage-backed securities spread, they became the foundation of a much larger machine. Derivatives. Financial instruments built on top of other financial instruments. The most famous were called collateralized debt obligations, or CDO. These products didn't just contain mortgages. They contained slices of other mortgage products. Layers built on layers, risks buried beneath abstraction. Even experienced investors couldn't fully explain what they owned, but they didn't need to. The ratings said it was safe. The returns were higher than bonds, and housing prices, everyone believed, could never fall nationwide. That belief wasn't questioned. It was assumed, and that assumption powered the entire system. Around this point, something subtle but critical happened. Financial institutions began betting against the very products they were selling. Using instruments called credit default swaps, banks and hedge funds could profit if mortgage securities collapsed. This is often portrayed as sinister, but again, it was legal. No disclosure required, no obligation to warn buyers. You could create a product, sell it as safe, and quietly take out insurance that paid you if it failed. And when those failures started to happen, the incentives flipped. The worse the system performed, the more money certain players made. This is where the third loop locks in. A system where collapse is not a failure, but a strategy. For a while, nothing seemed wrong. Housing prices kept rising. Defaults were manageable. Early cracks were ignored. When some borrowers began missing payments, the response wasn't caution. It was expansion. New products were created to absorb the risk. New models justified continued growth. Complexity acted as camouflage, and because everyone was making money, skepticism felt unnecessary. Even regulators trusted the models. Even central banks deferred to market efficiency. Warning signs weren't hidden. They were reframed, temporary, localized, contained. Then housing prices stopped rising, not crashing, just flattening. That was enough. Adjustable rates reset, monthly payments jumped, defaults accelerated, and suddenly, the mathematical assumptions holding the system together collapsed. Mortgage securities began losing value, but no one knew how much. Because no one knew what they were actually holding. Trust evaporated. Banks stopped lending to each other. Liquidity vanished overnight. What followed wasn't a slow unraveling, it was a cascade. Lehman Brothers collapsed. Bear Stearns disappeared. AIG required a government bailout to honor the insurance it sold on failing products. And suddenly, the entire global financial system was at risk. Here's the moment most people remember. The bailouts. Trillions of dollars injected into banks deemed too big to fail. Institutions saved. Executes retained. Bonuses paid. Meanwhile, millions of ordinary people lost homes, jobs, and savings. And this is where the emotional weight of the crisis settles in. The realization that the system protected itself first. Losses were socialized. Profits had already been privatized. And when the dust settled, the question everyone asked was simple. Who was responsible? The answer was deeply unsatisfying. No single villain. No smoking gun. No clear crime. Investigations followed, but prosecutions were rare. Settlements replaced trials. Fines replaced accountability, and the narrative slowly shifted. From fraud to failure, from deception to miscalculation. The crisis became a tragedy, not a crime, but that framing hides the most important truth. The system wasn't broken by bad actors. It was enabled by good actors doing exactly what they were incentivized to do. This is the promise we opened earlier. The reason T2008 financial crisis feels different from other scams is because it didn't rely on lies. It relied on structure, on complexity that discouraged understanding, on incentives that rewarded short-term gains over long-term stability, on legal frameworks that allowed risk to be created, sold, insured, and abandoned without consequence. And once you see that, the final loop closes. You realize this wasn't an exception. It was a pattern. The mechanisms that caused 2008 didn't disappear. They evolved. Complexity still hides risk. Ratings still replace understanding. Incentives still favor growth over caution. And every time a system promises safety without transparency, efficiency without accountability, or returns without risk, the same logic applies. The scam wasn't illegal. That's what made it work. And that's what makes it dangerous. If you understand how the 2008 financial crisis really happened, you stop looking for villains and start looking for structures. You stop asking who lied and start asking who benefited. And once you start asking those questions, you begin seeing the same patterns everywhere. not just in finance, but in systems that demand trust while discouraging scrutiny. If this kind of breakdown helps you see what others miss, stay with the channel, because the next collapse won't look like the last one, but it will follow the same rules.